Congratulations, Canadian Bank of Canada has cut another 25 basis points this morning, and the policy rate is now from 5% to 4.25%. So 3 consecutive rate cuts from 5 to 4.75 to 4.5 and now 4.25%. So yeah, 3 consecutive rate cuts. This was pretty much expected, guys, okay, by every economist and their mother. Like, it was pretty much priced in. There was no surprise in the market. But our dearest finance minister and the deputy PM, Chrystia Freeland, along with other MPs from the Liberal Party, has been congratulating Canadians and telling and making it look like that this is the best news we ever had, guys. We are the first country in G7 to start cutting rates and have cut 3 times, as it was the best thing ever happened to us. I'll let you be the judge. And she also said that this proves that her economic plan is working. You let me know in the comment section whether her economic plan is working for you. Let's get into it. So basically, yes, 3 rate cuts so far, and it was pretty much expected. And basically, some of the major banks like BMO and RBC are predicting that by January next year, we will be seeing the policy rate in the range of 3, like low 3s. Okay, that's pretty much the market is calling for. And the reason the market is calling for is because the unemployment is going way much faster than we initially thought. So 6.4 reading that we have, this is actually a lagging number, right? This is basically what we had 2 months ago. Okay, so by the time we see the unemployment for the current period, it might have been above 6.5, 6.6%, who knows, okay? So definitely unemployment is the big concern. Inflation is not a concern anymore because the economy is stalling, okay? The Bank of Canada's governor, he himself said, the excess supply in the economy continues to put downward pressure on inflation. So what happened was, when we had the disruption in the supply chain during pandemic, so we had, lack of supply, but the demand was actually there. So it actually put an upward pressure on the prices. But now that those supply chain issues are now resolved, so we have this excess supply coming into the market, which is putting downward pressure on the price increases. So prices are still going up, but at a much lower pace. Okay, so understand the difference between inflation and the prices. Prices are still going up, but at a lower pace comparatively. Okay. He also mentioned the base effect. So if you look at the month over month reading on this chart, you can see that last year, the same period, June, we had a lower monthly reading. That could be one of the factors that we have seen the inflation coming down in June and July. And going forward, we can see, last year, those monthly readings were actually quite up, right? So because of this base effect, we may be able to see an uptick in the inflation in the next 2 or 3 readings, okay? So that's the concern they also had as well. And they're saying that, the food inflation and the shelter inflation is still high. Okay, that's what they're concerned about that. But I think the inflation is not their concern anymore because the economy is too weak now. And because the economy is too weak, there's not much spending going on apart from the government spending, which is the 80% of the total spending. This is the main driver of keeping the inflation lower. Okay, so because the economy is stalling, especially the private sector, now everybody's scared about real economic contraction because the private sector is struggling. We are seeing pretty much all the spending coming from the government, but the private sector is the one that is going to drive the economic growth, right? That is going to create jobs and opportunities and activity in the market. If that's not growing, we are in real recession, whether we government declare or not declare. So that's the number one concern, which is why they're going to actually cut the rates aggressively. I think the other economists like BMO and RBC, they are actually predicting that the rate cut is going to accelerate because the economic situation is much bad. And in order to basically recover that economic contraction, the Bank of Canada has to aggressively rate cut. And this has been my thesis for longest time that whenever the rate cuts happen, it is because the banks, the central banks, are responding to an economic crisis. And we are literally seeing that economic crisis unfolding in Canada, because pretty much every week I'm hearing the layoff announcement from other companies: TD Bank, Cisco, right, Bell Canada. So all the major corporations who employ in the private sector are laying off people like on consistent basis, and it's not just one-time activity. The companies are laying off people sometimes twice in a year. Okay, Cisco has announced layoff back in February, and now again. So these unemployment numbers are going to shoot up, and that's one of the major concerns, that why economic growth is so aggressively stalling. And in order to basically recover that, they're going to aggressively cut the rate. Now, a lot of bulls on the Twitter are predicting some sort of a bull run because of that. I disagree with that, because, as I mentioned, you have to have economic strength, okay, in order to drive that bull run. We have unemployment going up, which we did not have in previous bull runs. Of course, in pandemic there was a sharp unemployment spike, but it came back up very quickly as well because of the government stimulus. So we have now unemployment going up, excluding the pandemic era, which is the highest since 2008 crisis. Okay, we have the private sector contracting, government is expanding, but private sector is the one that is going to produce jobs and opportunities. So that is the problem. And then we have these tariff wars going on, right? So that's another topic that I wanted to cover in detail. Canada, under pressure of US putting tariffs of Chinese EVs. In retaliation, China will put tariffs on Canadian goods as well, like canola oil. So this will backfire, to be honest, very, very badly. So all of these things are going to make the economic recovery even much slower, much difficult, right? Oil prices are not spiking up because of the global recession, and that's another sign, why the oil prices are actually not going up, is because there's no demand in the global economy, and the demand is going down is because of the global recession. So when you look at across the globe and connect the dots and create a holistic picture, you realize the economic situation all over the world, including Canada, is much worse. And in that situation, you don't see the bull run happening in the real estate industry. Okay, if you are not sure about your job security next month, okay, you won't be putting an offer on $1 million property. It is as simple as that. So I have seen people being laid off, and I'm seeing a lot of people still unemployed after 6 months of layoff in the market. So it's not easy to find another job in this market. So I don't think, I could be wrong, but I don't think the economic situation is perfect for a bull run in real estate market. But a lot of bulls in the real estate industry on Twitter are kind of predicting that this is going to happen. I don't think this is my base case, but you let me know what you think about that in the comment section, and let me know how are you protecting your financial well-being and investment portfolio, because this channel is all about giving you the alternative perspective that you can prepare yourself what's coming. Okay, the economic situation is not good, guys. A lot of people are so blindsided what's coming ahead. So be prepared, protect your finances, protect your investment, and make sure you play wisely, because things are going to get worse very soon, and in that case government will not protect you. You have to protect yourself. So be patient and be wise. Let me know what you think about that. Put your comments down below. If you like this video, give me a subscribe and thumbs up, and I'll see you in the next video. Take care. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and it allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.